Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Michael Normyle, U.S. economist at Nasdaq, to discuss the market's reaction to the Fed rate hike, and we'll also take a look at expectations for the ECB. Michael, it's great to see you as always. Welcome back to Trade Talks. And as expected, we got the rate hike, 25 basis points. How is the market reacting now that Jerome Powell is in the middle of his press conference?
Well, it seems like the initial response to the release of the statement at 2 o'clock was pretty mild, but now that the press conference is underway and Chair Powell, he seems to have been, from what I saw before joining you, he seems to maintain the data-dependent stance where kind of anything is possible in September, where we could see a pause or we could see another hike. So it seems like the Fed is not sticking too hard to the talk of two more rate hikes, or at this point being one more rate hike from what they were discussing at their previous meeting.
Well, the two key data points that they're focused on, of course, are the labor markets and inflation.
Exactly. Yeah. So if you look at where rates are now for the U.S., we're at 5.5%, and that's 525 basis points in rate hikes to this point. And a lot of the reason that we've seen so high rate hikes from the Fed, where we're at a 22-year high for the Fed funds rate, is, like you said, because of employment and inflation. And so the Fed is watching that going forward, where the labor market, for example, we still have 1.6 job openings per unemployed person. And so even though we've seen the amount of jobs added in recent months slowing down, it's still far more jobs available per unemployed person than the Fed wants to see. They'd like it to be closer to 1-to-1 ratio for job openings per unemployed person. So we're still way above that, even though we're down from a peak of 2 job openings per unemployed person. And then the Fed Chair Powell did mention the progress that was made on inflation with the latest CPI report that we had earlier this month, where we saw CPI drop from 4% to 3% in year-over-year terms in 1 month. And a lot of that has to do with the continued deflation in energy prices. But we've also seen negative contributions from used car prices. And finally, the long-awaited declines in contributions from housing and the rest of core services, which is more kind of wage-driven. And so that's really what the Fed's been wanting to see. And Chair Powell noted that that is the progress that they've been looking for. But of course, one really good inflation report isn't enough to have them pause at this meeting or commit to pausing going ahead.
Let's talk about the ECB, the European Central Bank. Their progress on inflation is not quite what we're seeing in the U.S. just yet.
Right. So they have a meeting tomorrow. So the expectation is an additional hike from them. And a lot of that has to do with core inflation hasn't come down very much in Europe in general. If you look at the Eurozone core inflation rate, and same for the UK core inflation rate, both of them are very close to the peak rates that they've seen through this cycle. So there's more to be done in terms of bringing inflation lower there. If you look at headline inflation for Eurozone, US, UK, they're all have turned down pretty clearly, but that's really the same energy story. And it's really that the US has made more progress on core inflation, with the core services and housing components starting to ease, as we had discussed previously, but they're still dealing with the tight labor markets like we have in the US, in the Eurozone. And so that's contributing to higher wage growth there and keeping core inflation still elevated there. So they want to see more progress, and that's why markets are pricing in a couple more rate hikes for the ECB at this point.
All right, Michael, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.